Retail sales falling flat in September as inflation runs hot, forcing Americans to adjust their spending habits in the face of rising costs. Here to discuss what this means for the economy and Fed policy moving forward, we want to bring in Austan Goolsbee, University of Chicago professor and former chairman of President Obama's Council of Economic Advisors. Mr. Goolsbee, it's great to see you. Certainly a lot of news happening this week. We got that hotter than expected inflation print, 8.2%. Retail sales out this morning, they were flat in September. Just give us your sense of the economy, given that new data that we've been getting over the last couple of weeks.
Yeah, thanks for having me back. I mean, I think we're in this transition period, and it's a transition on multiple dimensions. One, consumers are shifting back to spending on services from spending on physical goods. Two, inflation continues to be hot. You saw core inflation coming in higher than expected, higher than the Fed wanted. And in an environment like that, where the real wage is going down, salaries are not rising as fast as prices, you're going to see some slowdown on the consumer spending front. And I wouldn't be surprised if where you really start to the rubber hit the road, see it on consumer spending on durables, automobiles, and housing, the most interest rate sensitive parts.
Austan, good to see you. What do you think the likelihood of a recession is? And do you think the Fed will at some point call it a win if they get an inflation number around 3% rather than the ideal target of 2%?
I'd say recession's absolutely a real possibility. As you know, the main cause of recessions post-World War II has been the Fed raising interest rates faster than the economy can handle. What we have to hope, and for sure what the Fed is looking for, are improvements on the supply side, that all the negative supply shocks that, in my opinion, drove a lot of the inflation in the U.S. and around the world, that as we get out of the COVID times, and maybe if the war doesn't deteriorate in Ukraine, we could start to get some positives on that side. That's how you would avoid recession and have a soft landing. But if not, I think that's absolutely on the table. And I don't think the Fed will, from the public announcements, you don't see much wiggle room in that the Fed saying, oh, well, if we get 1 month of beneficial reports, then we'll declare that our job is over here. I think they would need to see sustained slowing of inflation before they're going to think that it's time to pause.
Also, what do you think of the Fed's job so far, just in terms of how much progress they have made up until this point?
You know, the Fed gets criticized from all dimensions and all sides. This has been an extremely difficult period for the Fed to navigate what to do, not just because you have to figure out, is the inflation coming from supply shocks, which raising interest rates doesn't fix, or from excess stimulus and excess demand, which interest rates could. You also have this whole added bit that our recession looked nothing like a previous recession, the one in COVID, because it was concentrated in services. And this issue of pent-up demand for services makes the normal Fed job of we apply the brake to counteract how fast the economy is growing. But it makes that based on no historical record. There's never been any business cycle that looked like this. So it's very hard to weigh off is everybody going to go to Disneyland for 2 weeks this year and go out to restaurants every night of the week because they've been locked up in their houses for a year and a half? If so, then the economy might overheat on consumer spending grounds, but that's never happened before. So the Fed doesn't know exactly what to do.
When you see two different companies in two different sectors, I'm talking Pepsi here, who said we dramatically increased prices. We saw no demand destruction. Delta Airlines, same thing, with airfares up 43% year over year. No waning demand, record demand. What does it tell you the Fed is going to need to do in order to get cost control, as they call it?
Well, this is back to the fundamental religious divide of, do you think the inflation and the price increases are coming from supply shocks and cost problems, or do you think it's coming from excess demand? If you think it's mostly from excess demand, then what the Fed is going to need to do is keep raising rates to try to tamp down demand.
But you think
if
it's
you
supply?
think that a lot of it's coming from supply, and the fact that you've got inflation rates of 10% in Germany, 9% in the UK, and high inflation all around the world, and there's not a single country on the planet that's below the 2% inflation target, those make you think, whoa, will the Fed be able to do anything other than generate a stagflation? So I think this is really the nugget of where we are and what we're trying to deal with.
Austan, where does this leave jobs in all this? Because we know the Fed has said that we need to see job losses in order to get inflation under control. That, of course, has been up for debate. Where do you stand on that?
Well, be careful. The Fed said that they need to see a cooling of the job market. But I think what the Fed is hoping is that they could reduce the number of vacancies without driving up the unemployment rate or putting people out of work. And for a couple of months, at least, they have been able to do that. The job market remains remarkably strong. And if the unemployment rate went from 3.5 to 4.5, 4.5 unemployment rate is still a very low unemployment rate. There are periods not that long ago where people would be saying 4.5 is full employment. So I'm hopeful that the Fed can navigate this with a little good fortune on the supply shock front, that they could navigate it without having a dramatic increase in unemployment. If not, if we don't get improvements on the supply side, then we're in the kind of the old-fashioned environment where there's just a direct trade-off. And if you want to get inflation to come down, you've got to administer pain.
I'm sure you're always looking, Austan, at the labor force participation rate, which is stubbornly below where it was pre-pandemic, and maybe 1 million of those people retired and are gone for good. How can the Fed get that labor force participation rate back to where it was, maybe the 1.5 million back to work?
Well, again, be careful. You've seen a dramatic increase from the trough upward in labor force participation. It's trending down over a 10, 15-year period, partly because you got the baby boom retiring, partly from demographics. And then you've got the double whammy of long COVID and people taking care of people with COVID. That's 500,000 to 1.5 million out of the labor force. And then you've had a massive drop in legal immigration into the country. Those two things are longer term, unfortunately, than what we wanted them to be. Hopefully we can get past the long COVID part, but without returning the flow of immigration, I think we're still going to be dealing with this labor shortage type issue for some years to come.
A rough road ahead. Austan Goolsbee, always great to have you here, sir. Appreciate your time.
Great to see you again.